if you're like 99% of retirees or soon to be retirees, your main concerns are how can I make sure that the income stream I begin to take is going to keep in pace with inflation? How can I make sure this income stream lasts me throughout my retirement? As you've seen, everybody's living till 90, 95 nowadays. And how can I make sure that in the event of a 2008, 2009, I don't end up in Lowe's or Home Depot or Walmart being forced to be a greeter because I don't have enough income to live off of? It's extremely difficult nowadays to navigate between all of the different, Facebook, Google, YouTube, TikTok, Instagram, all of these different social media platforms that have different advisors telling you that this is the way, this is how you do it, this investment will get you there, whether it's all ETFs or all annuities or all IUL or all stock market or all hedge fund. You see all of these different strategies that people swear on. And all of these investments are great. We completely agree that all of these investments have a specific purpose. But the problem is you can't put all of your risk inside one silo of investment. We're of the notion of siloing your risk throughout different investments. And how we do that is we want to make sure that to complete your goals of, hey, keeping in pace with inflation, making sure we don't have large principal downsides, and also making sure that you don't have to go back to work is by keeping half of the money outside of market risk and half of the money inside market risk to keep in pace with inflation. So how do we do that? There's a couple different ways. One of the ways could be, hey, with the portion of the funds that are outside market risk, we could go with something like a high yield savings. It could be a money market fund, could be a bond portfolio, could be an annuity product. How do we navigate which one's the best? That's the most difficult part. What we've seen with the best success over the years is these fixed index annuities have been able to produce anywhere from 6 to 10% to help slowly grow the portion of the funds, not be a real home run hitter, but be able to keep in pace with inflation and make sure that those funds don't lose value. So for those of you that aren't familiar with fixed index annuities, what happens there is they're backed by indexes like the S&P, could be QQQ, NASDAQ, a lot of different indexes you're likely familiar with. The benefit to those is you don't get all of the upside, but you get none of the downside. So with that half of the money, we're not going for the home run hits like I mentioned earlier. We're just trying to make sure that we don't have the downside losses. And then with the other half of the money, we typically want to use something like a low cost ETF portfolio. And a lot of the times people tend to, go with these mutual funds or other products that are very high fee. We're of the notion of keeping it light, and those don't seem to outperform you at all because having a 2 to 2.5% management fee to kick out income over that time frame will gradually deplete your account value and hurt you in the long run. So what we have is these two different moving pieces that help you accomplish that. So how does it actually accomplish it though, and how does it look in practice? What you'll see in this example, again, is a $1.5 million example. We're starting with $750,000 in the fixed index annuity, $750,000 in an actively managed ETF portfolio. Okay, so what you'll see here is each year the money is getting invested, it's gradually increasing. You'll see that the ETF portfolio, of course, is going to be growing a little bit more than the fixed indexed annuity, but they're starting to kind of ladder between each other over the years. Why is that? So what we do with this strategy and what E.F. Hutton proposed is when the market is up, what we want to do with the market portion is capture those gains, kick that to you as income, and keep the fixed indexed annuity invested over that time frame. So that in the years when the market is down, we're able to use the fixed indexed annuity to capture the income and always let the ETF basket recover. Just think of it this way. Let's say, again, I'll use a $2 million example here instead of a $1.5 million example, just for pretty number's sake. So let's say we have $2 million in the stock market, and I'm of the notion of stress testing every strategy. And if you eventually, get one of these filled out here for you, we show you how that's stress test. So how that's stress tested, excuse me. So what you want to see is what happens when you have something like a 40% loss in your account. And let's say you're taking off $2 million, $100,000 a year, just for example. If you lose 40% of the account value and everything's in the market, like a lot of these firms propose, 40% of your account value is $800,000 wiped away. Now you're at 1.2 million. Again, let's say we're trying to invest or we're trying to take $100,000 of income each year. Now you're at 1.1 million in that year. The amount of funds it's going to take for you to recover, or the amount of percentage it will take you to recover back to that, is anywhere from 80 to 90% to get back to your original principal value, not keeping into account the idea that each year you're still going to have to take that $100,000 to live. Let's say it's long-term care or memory care. Those bills don't stop running, or the bills don't get lower in the time frame where the market is down. So in that example, it's going to be really hard to recover, and you may not be able to fully recover in that time frame given your age. So what we like to do is, let's say half of that money was in the FIA, instead of all the money being in the ETFs or a stock portfolio or a large managed mutual fund. You see where I'm going with this. If we were to go down 40% on half the money, that means we are only down to 1.6 million compared to being to 1.2. And let's say we took that original $100,000 of income that I mentioned earlier. Now we're at 1.5 compared to 1.1 million. All we need is anywhere from a 30 to 35% return to get back to where we were, compared to an 80 to 90% return. Almost 2.5 times less of the return if we were in the market. Because what will happen is we're able to take from the FIA, from the fixed indexed annuity, utilize that for the income in the years where the market's down, so that we never have to sell the basket ETFs for a loss. So what you'll see up here is some numbers that put that into practice. And let me make this a little bit wider here. What you'll see is in the years that the market's down, we take from the FIA portion so that we can always let the market recover in those next years. And over the time frame, you'll see, again, in this negative 9% year, we go to the fixed index annuity portion and take out the $90,000 income stream. In this example, we did it for a flat 90 grand a year. What typically happens is we increase this anywhere from 2 to 3% each year, like your normal advisor probably would, just to keep in pace with inflation. But you see in practice that with the two laddering together, we can maintain our principal value over the years, even when we have large swings in the market. Like, for example, there's a big swing here with a negative 14%. What happens there is, rather than us going from 1.117 here to 950,000, then taking another 90,000, and could have been at 840,000, we instead take from this portion instead on the 1.201 million, take out that 90 grand. Now we're at 1.111, or that was too many ones, 1.111. Oh, I got it right. And then from there, we're allowing this portion with the basket of ETFs to recover. So with the two laddering together, we're able to, for one, maintain our principal value, and then two, make sure that we don't have to necessarily net a loss. The problem is with being fully in the market is when, again, you're down that could be 20, 30, 40%, like we saw in 08 and 09. If you're taking income on top of a loss, it's that much harder for you to recover in that time frame. And so with these two leveraging together, we're constantly able to ratchet between the two. And on a 10-year basis, we'll just reallocate the funds and start over again and rebalance it. Like you'll see here at the end, the FIA is slightly over the ETF basket. But what we'll do is, let's say it's at, what's the math there? Let's say 2.3-ish million, just for number's sake here. What we'll do is the same strategy itself. We'll take money outside of the annuity, put it back in the ETF portfolio, and then restart the strategy all over. So this is the way that everybody in EF Hutton's umbrella would invest the funds to make sure that their retirees could have the income coming in the door. Because if you are in retirement, let's say your income needs are this 90 grand a year. Mark it up, mark it down. If you know that you have that $90,000 a year coming in the door, you're not worried about the downside in the market, because you know we can let it recover. And you have the time to let it recover because we have half that money outside of market risk. So keep this in mind when your advisor tells you, hey, everything in the market's going to be just fine. If you can stomach a 40% loss, not just in theory, but in actual practice, stomach a 40% loss and feel comfortable with taking income against that, stick with that. If that's not something you feel you can retire with and be not, staying up at 2 a.m., sweating your face off, anxiety everywhere, if that's something that you feel like is going to constantly be wavering over you, this is the strategy that keeps that in place. And again, there is going to be no stress-free retirement. There's always going to be something that comes up. But if you know that constantly half of your money is outside market risk and you can always let the market recover, you are going to be a lot safer.